Welcome to the InterMarket analysis video update. This is a weekly video. And if you've watched these videos before and you've been watching them on a consistent basis, I'll just tell you up front, there's really no changes this week. I like to do this video every week just to review where things are at. And I go through a number of different areas that I'll go through here in just a moment and give you the broad categories. But we're looking pretty positive right now, but we're also heading into a weak seasonal time. Now, as I've been saying in all the videos that I do, I was watching for weakness develop in the middle of July. I wasn't predicting anything, but I wait for the charts to actually show that's what's happening. It didn't happen. Then August. We'd never had a positive August going back to 1950 during a post-election year. This year we had one. Now we're coming up through the first half of September, which is not all that great in and of itself. But then we come into the second half of September, and that's the worst performing half of the month for the entire year. Again, going back to 1950. Now, a lot of people know that. A lot of people are concerned about that, and that's probably what's been keeping the market up to this point. We're not seeing a lot of enthusiasm as far as buying, but we're not really seeing any convicted selling either. But we just want to keep an eye on things. And then we use the intermarket analysis video to say, okay, what's feeding into the stock market? And then use that as a foundation for our overall evaluation of the market. So this is being prepared for Monday, September 15th. The first area that I'll go through is valuation. We're still overvalued, whether you look historically at earnings reports that have already come out, or if you look forward at projections, they still show that we are overvalued for the S&P. Then I go through a lot of different charts for growth versus value. Growth is still outperforming value. In a positive environment, that's what you'll see, and that's still continuing. We saw some weakness starting to come in beginning part of August, and still there are some things to be a little bit concerned about. There's always things to be worried about, but we're not seeing a big shift like we saw in late 2021 going into 2022. So at this point, if we see some kind of a pullback, it looks like that's what it will be, a pullback, just a normal decline. Folks taking some profits to lock those in. But then if we start to decline, we'll just evaluate that on a day-by-day basis, see if some of our intermarket analysis charts are shifting over and changing their overall characteristics to become more defensive. We're not seeing that right now. Then I go through inflation. Now, I'm getting a bit of a contradiction here. If you look at the daily charts, and I use the CRB index, which are commodities. When they're going up, that tends to be inflationary. When they're going down, that's deflationary. The daily charts and even the weekly charts are not really showing us anything all that drastic. But there's one chart that I'll come up with here in a moment that is looking a bit concerning, but it's more of a proprietary chart. So I'll deal with that when I get to that chart. We look at other markets just to see what's happening, markets that are outside of the stock market. I go through the 11 sectors of the S&P. First, we look at the sector by itself, and then we do a ratio of how is it performing when compared to the S&P 500. We look at a lot of different indexes to see, okay, what's happening in technology, what's happening with the small stocks, the big stocks, the middle stocks. And then we look at correlations between different markets. Then we look at some very long-term trends, mostly using monthly charts there. And then at the very end, we have a positive and negative list. And I'll just tell you up front again, the list has not changed. Everything that I put on that list is positive. The only thing that's negative right now is the US dollar, and that's the way it's been for most of 2025. All right, valuation. Overvalued here. The red dashed line, that's a PE ratio of 20, and we would have to come down under 4,400 just to get to an expensive level, and we're way above it right now. But we've been above it for years now, and so we don't use this for timing. We just use this more for information. This is that same chart, but just taking it all the way back to 1980 and what the valuations were as different events unfolded in the stock market. Then Robert Shiller's version of the PE ratio, instead of looking at earnings as they're released, he takes a 10-year period of time to try to smooth it out. And it's coming in expensive here at 39.56. I base this around the median and the mean. There are some different studies that you could put on here, like standard deviation measurements and things like that to see, are we moving up, we moving down too much. I pretty much just take this chart for what it is, and this, but we don't use the 15, 10, 15, 20 scale with this chart. I just look at it all the way back into the 1800s, and you can see that we're very overpriced on this chart as well. Then we look forward at the forward PE ratios, and we have the mega cap 8. This is put out by Edward Yardeni. Usually it's a magnificent 7 that the market focuses on, coming in at 29.8. That's where we do use the 10, 15, 20 scale, and we're coming in at 29, almost 30. So yeah, but they've been overvalued for quite a while. But these companies are making good, solid earnings, and so their earnings are going up and they're seeing profits, maybe not as robust as we would like when we look at this chart, but that's why folks are still willing to buy those stocks because they can buy them high and then sell them even higher. At least that's the hope. Then we look at the S&P forward PE ratio for the S&P itself. It's above 20. So it's at 22.4. Again, overvalued there. And then we look at the mid caps and the small caps, more fairly priced, coming in between 15 and 16. Then growth versus value. So first of all, I just look at growth, looking pretty solid right here. And it's not like value is falling apart. It's in an uptrend too, and actually showing a little bit of a breakout. Where we get more insight is when we do ratios between the two. And this shows how growth is outperforming value. The inverted version of that same study shows how value is underperforming growth. Then we look at some ETFs, growth outperforming value, value underperforming growth. Then growth outperforming value with some indexes, value underperforming growth with the same index. And then another ratio here, growth versus value, not really looking all that weak right now. Not, we would like to see this go up a little bit more and show some more strength, but it's certainly still positive. Then an inverted version showing how value is underperforming growth. So then on a bigger picture level, we see the same thing, whether we're looking at ETFs or indexes. Then we break it down. We look at small caps. Now, this is a little bit of a concern because this ratio, growth to value, is starting to really drop off. As the index has been seeing some favor lately and trying to break out, to see this ratio going down, that is a concern. And we're improving here when we look at mid-cap growth to value. We're getting back above the 50-day moving average, but we had been seeing some weakness developing in here. And we're seeing a little bit of weakness here. The growth to value ratio for the S&P. This is the one that I focus on the most. Not falling apart, still in an uptrend, but we would like to see this get back above the 50-day moving average and resume its upward move. And as this is going down, that does mean the market's becoming more defensive. And that started right about at the beginning of August. That's where we saw this dropping off. And we were not seeing any more weakness, but we're just kind of going sideways right now. If we do see some more weakness here, then we would get a little bit more concerned about the market becoming more defensive, meaning that it's getting ready to go down. And inflation. This is the chart that I referred to later, where the daily and weekly charts of the CRB index, and even here the monthly chart, it's not looking all that drastic. But there's Martin Pring, who developed some of these charts. This is an inflation to deflation ratio, and it's a monthly chart. And it had been really coming down overall with the moving average going down, but lately we've been seeing this starting to go up. We're not seeing a confirmation of that in some of the other charts, but this is a little bit of a concern, but a non-confirmed concern for right now. And this is a daily chart of the CRB index. See, it's not going all over the place crazy. It's, in fact, almost getting ready to go into a downtrend here. We're about ready to see a death cross with the blue moving average moving below the red moving average, but not any real problems with it, at least to this point. And then we look at another inflation measure. This is the Baltic Dry Index. And typically, as a general rule, when this is going up, that's more inflationary. When it's going down, that's deflationary. It is going up and it is in an uptrend, but it's not really breaking out at this point. Then there's a weekly ETF that we follow. What does the market think as far as inflation expectations? Not all that much right now. We've been just kind of chopping along sideways. Then there's this other instrument that folks have available to them called TIPS, Treasury Inflation Protected Securities. And when the market's concerned about inflation going up and interest rates going up, they get into tips because they adjust for inflation and interest rates, and they're usually shorter term. When the market is pretty convinced that maybe we've topped out with interest rates and inflation and we're going to start to come down, then they get out of tips and they get into longer term bonds because they can lock that in for 2, 5, 10, 30 years, higher yields, and then just ride out that yield with interest rates being lower than where they bought that bond. Well, we look at our ratio here and we're drifting down here a little bit as inflation expectations are actually underperforming tips. Little bit of a concern there. That means that tips are outperforming right now, but we're not really seeing a general shift in the overall mood. And some other markets, here we see where aluminum has been coming back up, but it's still in a downtrend and bouncing back up. We're coming into the season now for corn, but corn continues to be in a downtrend. Wheat is also in a downtrend. Fertilizers has been falling back a little bit. And lumber, really, timber. But we're still in an uptrend, but we haven't crossed over to a death cross yet. But we've been seeing lumber prices really coming down. And oil's drifting lower. And as I usually say, I follow this mainly for geopolitical reasons. When things really get crazy in the Middle East, oil goes up. You can see this is when the Russia-Ukraine war took off. Now, the U.S. isn't as reliant on Middle East oil as it used to be, but there's other countries that are. And so this is, for right now anyway, it's mainly been behaving, and we're in a downtrend getting to the lower 60s. And we look at the correlation between the 10-year yield, which is in black, and oil, which is the red dashed line, and we see that they're pretty much going in the same direction right now. So if interest rates are going up or down, oil is usually going up or down in the same direction. And gold to oil, oil's been going down, gold's been going up, so that's why we're seeing this ratio going up overall. Gas continues to go down here, and it's actually starting to signal a downtrend. And then heating oil kind of chopping around here as the we get through the summer months and it starts to turn a little bit colder. Natural gas also still in a downtrend. And then diesel, it started to go up, but now it's falling back a little bit of a recovery in prices lately, but not a real significant shift. And copper, which I use as a barometer of the economy, it got hit after some tariff news came out that impacted copper. And it's not looking all that strong, but it's trying to make a little bit of a comeback here on the daily chart. And then we look at a copper to gold ratio, and this is going down. That means copper is underperforming gold. Longer term version of the copper to gold ratio. And typically what we see is the 2-year yield and the 10-year yield, they tend to move more in tandem. They're a little far apart right now, but they are all having a tendency to go down right now. And gold is doing pretty well, breaking out. Didn't set a high on Friday, but it did set an all-time high within the week. Now I look at the gold ETF instead of the futures contract there, but we did set a new all-time high with silver. And we look at a gold to silver ratio here. This is going down, which is what it's been doing lately. That means silver is outperforming gold. And then we do a correlation with the US dollar index, and it's pretty much neutral. They had been going in the same direction. That's when we get a high reading with the correlation. Now it's coming back down, and so we're looking to see, is there going to be a shift in the overall character of the market because they were going in the same direction. Now it's coming back down. If they start to go in opposite directions, that could mean the market is shifting a little bit. But the dollar, both on the daily chart here and the weekly chart, in downtrends. And that's been helping stocks to go up. Stocks like a weaker dollar. And we look at the euro, which is going in an uptrend compared to the dollar index down here. To give it a little bit more context, the Japanese yen is also added to this chart. Not showing an awful lot of strength right now. But then I break them out. Here's the euro above its 50-day moving average when compared to the dollar. Here's the yen, still in an uptrend, but just going sideways recently. And then the British pound is above its 50-day moving average when compared to the US dollar. Then some different index ratios, and we saw a little bit of a move down on Friday where the mega caps held up better than the equal weight version of the S&P. But for the most part, this has been moving more or less in tandem with each other. But it's still the mega caps that are really driving things. And this is another look at the equal weight versus the weighted version. When this is going down, that means the equal weight is underperforming and chopping around lately, but the overall trend has been for the big stocks to really be controlling the market. Then we look at a ratio between stocks and commodities. Stocks are outperforming, and this shows where commodities are underperforming stocks. Then the Nasdaq 100, which is outperforming the S&P. Now they're both coming off of all-time highs, but it shows here that the Nasdaq 100, which are the biggest stocks that make up the Nasdaq, are outperforming the S&P itself. Then the Nasdaq is outperforming the S&P. But what's really shifted going back here about late spring into the summer, we started to see the Nasdaq 100 underperform the rest of the Nasdaq composite itself. Again, when I hit this chart, I always explain it this way. You could take this as negative with the Nasdaq 100 underperforming, but the mega caps are still doing well all by themselves. There's other charts I'll show you later on. This is actually can be taken in a positive way too. That just means that the Nasdaq, which is a very broad index, is outperforming the Nasdaq 100. So there's more broad participation. The S&P 100 outperforming the rest of the S&P 500. Mega cap here doing really well. And these are also in the Nasdaq 100, but above the moving averages. The moving averages are going up. That's positive there. And mega caps, they are outperforming when compared to the equal weight, but not by a massive rate here. Then small caps, which had a good week a week ago, but they've got a lot of damage to repair to start to outperform the S&P 500. The red ratio shows how it's been declining. Now we could be setting up some kind of a base here, but we've seen a lot of fake outs with the small caps. They have a couple of good days, maybe even a good week, and then just kind of they inflate or deflate a little bit, and that's kind of what happened this past week. And the robotics and AI ETF doing okay, but not back to its recent or this previous all-time high set back in 2021. And when you compare the robotics and AI ETF, it's actually underperforming the tech sector. There's another ETF that I'll show you later on that's actually holding up a lot better. Then the Dow Jones Composite Average, which is the Dow, the transports, and the utilities, holding up quite well. We have the Dow near all-time highs. The transports are underperforming, and the utilities haven't set recent all-time highs, but they've been stronger earlier in the year, and that's helping this composite average to still remain positive and strong here. And small caps against the tech sector, showing how small caps, we saw some life there. We started to bounce back up, but now this is starting to come back down. Low volatility stocks, pretty much going sideways right now. They're not going down, but they're not really going up either. And this is what the market gets into when it's getting ready to be more defensive. Then we do a ratio, low volatility to the S&P, and this ratio is going down, which is what it's doing now. The market is more on offense rather than defense. All world stocks, taking out US stocks, looking really solid here, setting new all-time highs. Then you put the US stocks back into the equation, and it shows how US stocks are underperforming stocks in the rest of the world. Energy is underperforming tech. And growth stocks continue to outperform more conservative bonds, like government bonds and even high quality corporate bonds. And then the tech sector is outperforming the 10-year yield. This shows how the 10-year yield is underperforming the tech sector. Discretionary, this is encouraging. We've been seeing a real improvement happening here with the discretionary to staples ratio. This is showing how staples are underperforming discretionary. Gold, it's been going up, but then the S&P has been going up as well. But gold is kind of breaking out, and so we're seeing this ratio going up slightly here. And gold has been going up as the dollar's been going down. That's why we're seeing this ratio going up. Then we look at across the broad market here, and we're kind of going back and forth. We're looking more solid when we look at the NYSE common stock. We're still above the moving average as we are with the S&P, but we're dropping down below the moving average when we look at the mid caps and small caps. We were seeing some real hope there a week ago, but this past week they didn't really have all that great of a week. They did underperform. Then we have the Dow setting recent all-time highs here. And this is called traditional Dow theory, where you look at the Dow and you compare it to the transports. And the top chart and the middle chart should be confirming each other. Well, they're not doing that because the transports are underperforming. So this would be a traditional Dow theory non-confirmation, but we've been seeing that a lot in 2025. And then I add utilities to traditional Dow theory, which other people might not do that. Here's where we set the highs right at the beginning of August, but then the utilities have been coming down. Now lately they've been rebounding here a little bit, but they're not back to their all-time highs. So this would be a traditional Dow theory non-confirmation, whether you look at the transports and you can also include the utilities in that. Then this is a ratio between the Dow and the transports. When it's going up like it is now, that means the Dow's outperforming the transports. And the transports just kind of chopping along sideways when we look at them all by themselves. Also underperforming when we do a ratio between the Dow transports and the S&P 500 and the correlation because we have the S&P going up as the transports have been going sideways to slightly lower. That's why the correlation is really wearing off right now. Typically, we see a strong correlation in this red area. Now they're having a tendency to go in opposite directions. And we are setting all-time highs with the S&P, also setting all-time highs with the Nasdaq. That's a new way of looking at Dow theory. Instead of using the Dow and the transports, we use the S&P and the Nasdaq. And we break that down a little bit more. We are setting recent all-time highs with the equal weight S&P, but we're not there with the equal weight QQQs, which is the Nasdaq 100. Even though mega caps are leading here, you would expect this to be going up and setting new all-time highs. Now, is the market going to be able to come up? Is the highs set here with the S&P? Will that help influence the QQQ equal weight to go up? That could be the positive look here. Another negative look could be we're setting highs here, but we're not setting highs down below. And that's a negative confirmation there, or even a negative divergence. FANG index just coming off of recent all-time highs. Those are the really big stocks. The Wilshire, it was down a little bit on Friday, but it set an all-time high on Thursday. And we have the total US stock ETF setting an all-time high on Thursday. ARC just kind of going sideways lately, but still in an uptrend. NYSE Composite didn't set a new high on Friday, but it did set a new high on Thursday. All stocks, US and international stocks, holding up quite well, but it's the international stocks that have been outperforming US stocks in 2025. In this emerging markets, not quite back to the all-time high yet, but in a pretty solid uptrend. High leverage loans, another barometer of the economy, unchanged on Friday, but still well above their 50-day moving average. Bitcoin coming back up and trying to get back above its 50-day moving average, but still in an uptrend. And the Japanese Nikkei index just setting recent all-time highs here. And then the SMH semiconductor ETF starting to break out a little bit here. We want the semiconductors to really take a leadership role, and they haven't really been doing that all that much. They show some promise and then they go back, and then they show promise and then they pull back. Then the micro caps, not back to an all-time high yet, but also in an uptrend. These are the real small stocks. And then this is another look at the SMH coming up and actually looking pretty good, starting to break out of the rainbow. This is the other ETF, the AI and tech ETF, setting an all-time high and looking pretty solid currently. Then we look at the S&P and home builders. They like it when interest rates go down. And so that's been helping the home builders ETF to really improve. And we can see that the correlation between the S&P and the home builders is really quite strong. They're going in the same direction at the same time. And we look internationally, China is in an uptrend. Now this is the KST. It's a lot slower than like the MACD or the PMO or the PPO. This is a very long-term oscillator. And so we're starting to see a bit of an uptrend in China, turning up with the emerging markets in a downtrend in Europe, rolling over and in a downtrend in Japan, and trying to turn up, but still kind of in a downtrend here with the US. In a long-term chart, looking at US stocks versus world stocks here, and the bigger picture, still looking pretty good. When we use a momentum oscillator here, we're flattening out lately after we had been showing signs of improvement. Then bonds, this is the 10-year based on price. It's been pretty strong lately. It got the RSI above 70, and now it's been pulling back a little bit. The momentum is rolling over here as measured by the MACD, but it's still in seeing positive momentum. Total bond ETF, Not back to all-time highs, but in a pretty solid uptrend. And then the monthly chart of the stock to bond ratio coming down a little bit here, but in the bigger picture, stocks are outperforming bonds. This is also a daily chart showing how bonds are underperforming stocks. And the Pring World Bond Index, really choppy, but now starting to possibly break out a little bit here, but it has a lot of previous resistance that it has to break through for this to keep going up. Dow Jones Corporate Bond Index, looking pretty solid right now. And then investment grade bonds, these are more conservative bonds. They're also in an uptrend. High yield bonds, which are junk bonds, they're doing quite well. And then we look at a stock to bond correlation. So the price of stocks and the price of bonds have a pretty high correlated relationship right now. They're both going up or down at the same time. And here are junk bonds looking pretty solid. And then we look at the 10-year treasury yield. Really, the takeaway from this is that we're establishing a higher interest rate range than what we had been experiencing over the last 40 years. Then riskier bonds, junk bonds versus conservative bonds, starting to see a bit of a breakdown now, but we did see some recent improvement. We'll see if that can get back up and get in more into the rainbow, if not actually break out of the rainbow. Since the riskier bonds, junk bonds, they tend to follow more of what's happening in the stock market. And then some ratios. The S&P 100, excuse me, the S&P 500 to 1 to 3 to year. Okay, let me try that again. The S&P 500 to 1 to 3 year bonds setting new highs with this ratio. That's positive. That means stocks are outperforming. Then we look at junk bonds to government bonds, pulling back a little bit here, but still looking good overall. Folks are willing to assume more risk. Then we look at the yields, which have really been dropping off lately as there's real anticipation that the Fed's going to cut rates this coming week at their meeting. Then the weekly chart of international yields, the one that I've been focused on is the red line here. That's Japan. That caused a problem a year ago. If this really starts or continues to go up, we're wondering if that's going to cause a problem again. Then the volatility of bonds, that's the move index. We saw a big spike up and then a real pullback here. The volatility of stocks, that's the VIX. And we see that there's a pretty high correlation between the volatility of stocks to bonds. And then the S&P 1500 to 1 to 3 year bonds here, setting a high. Broad market measure, also setting a high here. That's positive. Stocks are outperforming bonds. The tech sector, not quite breaking out yet, but looking positive. Then the S&P 500 to the 10-year yield, showing how stocks are outperforming. And then this shows how bonds are underperforming stocks longer term. Then long term here, the long term 30-year, and this is the 20-year to 30-year. That's the UST here. It's a monthly chart, but we're showing some improvement. The hope is that maybe we're basing out here based on price, and we're pretty much going sideways when we look at a long-term bond to commodity ratio. Then the different sectors. Materials still hanging out above their 50-day moving average, but still underperforming the S&P 500. Communication setting a new all-time high here. That's a huge growth area and actually breaking out a little bit when compared to the S&P. That's positive for the market. Energy, really, really choppy. Just generated a recent golden cross, still above both of the moving averages, but underperforming when we compare it to the S&P. Financials looking good all by themselves off recent all-time highs. This is a chart I've been showing it every day, pretty much all summer, even late spring, showing how this ratio has been going down. That's a concern. We were starting to see an improvement here, but now we're falling back. We want the financial sector to do well. When the financials are happy, it's like in a family. If mom's not happy, nobody's happy. If the financials aren't happy, nobody's happy. But if we go back to this chart, they're looking good by themselves. So it's not like they're unhappy. They're just underperforming when we compare it to the broader S&P 500. And industrials just hanging around at their 50-day moving average, but underperforming the S&P. Tech sector, this is what we really want to see doing well, doing good, setting all-time highs here, and improving. It was improving. We saw a little bit of a pullback as we worked our way through August. And right now, anyway, it's still above its 50-day moving average when compared to the S&P. Staples just kind of chopping along sideways, but underperforming because Staples have been going sideways, the S&P's been going up, and that's why this ratio is going down. Real estate, just and they're very interest rate sensitive here. They're just kind of chopping along sideways, but really underperforming when compared to the S&P, which is what we've been seeing for a while. Utilities did set some highs, pulling back. Now they're trying to recapture their 50-day moving average, but when we compare it to the S&P, they're still underperforming. And this is the S&P to utilities ratio. And I stopped showing this chart and then I show it a time or two. When this ratio is going up, that means the S&P is outperforming utilities. And that's what we want to see in a more positive environment. Healthcare, very defensive in a downtrend, dealing with its 200-day moving average, and really underperforming when compared to the S&P. There was some hope here in August as the market was getting a little bit more defensive. Folks are like, man, healthcare, they've been getting beaten down so much. It can't go any lower. It can't go any lower. And so that saw a little bit of interest, but now it's kind of trailing off right now. This is an area that we'll watch if we start to decline and see if this ratio continue, if it goes back up. That means the market is becoming more defensive, but we're not seeing that at least right now. Sorry, I had to delay that there. You probably heard a buzzer in the background, just little ambiance there at no additional charge. So we're still seeing the healthcare more defensive, and we'll be watching that if stocks really start to decline. Then discretionary. This is encouraging to see this going up and doing really well by itself. Not quite back to the previous all-time high. Well, it's actually getting a little bit above it, a little bit. So that's looking pretty solid there. Not really outperforming the S&P itself. We are in a downtrend, but if we could see this ratio continue to go up, that would be more positive. When we see more strength is when we compare the discretionary sector to the staples sector. And semiconductors doing pretty good, not back to all-time highs here with the SOX index. And then this is the Dow Jones Semiconductor Index, just coming off of recent all-time highs. And we want to see semiconductors take leadership. And then this is what we want to see improve, though, is the semi to tech ratio. We want the tech sector to do well. We want semis to do well, but we want semis to do even better. You can see in early 2024, they were taking a big leadership role. Now, it's not mandatory because we still went up in late 2024 and we're setting new all-time highs as this ratio was going down. There were other parts of the market that started to come in and take a leadership role. So it doesn't we're not dependent on that, but it would be more positive if this ratio was to continue to go up. And the semiconductors to Dow ratio looking pretty good here, but still below the blue line. And then our intermarket analysis chart with gold, that's the best performing asset in 2025, followed by stocks. Then we have bonds based on price. And then the purple line are commodities, where we have oil and the dollar are negative year to date. Then at the end here, we look through correlations where we look at the S&P to the dollar. And they're having a slight tendency to go in opposite directions. So the S&P has been going up as the dollar's been going down. And that's why I'm saying that stocks like a weaker dollar for exchange rates, for import-export relationships with all the tariff stuff that's going on and trade deals. When the correlation is in opposite directions, that actually helps stocks. Then we look at the S&P to oil, also tendency to go in opposite directions. And then the S&P to the 10-year yield, also opposite directions, which is kind of what you would think would happen. The tech sector to the 10-year yield, also opposite directions, which is what logic would dictate there. And also opposite directions when we look at the S&P to short term, the 2-year yield. Then we look at some very long-term charts here. This is a monthly chart of the NYSE, setting all-time highs above an advancing moving average. But the cupping curve is still going down, but it's trying to turn up a little bit here, but it hasn't crossed over positive yet. Then another monthly chart of the NYSE, and then this is the new NYSE record high percent index. And when this is going up, that's more positive, and that's what we see happening here. Then a monthly chart of the S&P above a longer moving average, also going up with the PPO, a momentum oscillator, and then the S&P on top, and then a ratio between longer term, the S&P and CRB. Now this is conflicting what I was saying earlier, where we're a bit concerned about inflation versus deflation. This is not confirming that. This is showing how stocks are underperforming the CRB index longer term after they had been outperforming. So we'll have to see. Is that going to feed into this inflationary ratio that we're seeing earlier? Because this is starting to turn back up. Now, if this continues to go down, then we might be a little bit more concerned in the bigger picture. Then another US to global measure here, still above the moving average, but still declining with the KST. And at the end, here are all the positive things. And it's so long, I just kind of bring up the list here and say, okay, you want to pause this and look at it. But these are the major assets that we go through, and all of them are in uptrends currently. Then we switch over to the negative side, and the only thing that's really in a downtrend is the dollar right now. Thank you. I hope you found this helpful. Have a great weekend, and I will talk to you in the next video.